Mm.
Hi, and welcome to TMC Connect. We're going to let everybody come in, going to give them about 30 seconds, and then we'll get started at the top of the hour. Thank you so much for being here. How was Philly? Did you have a good cheesesteak?
I didn't, but I did get to go out with the team. There's a lot of the team who lives in Philly, so it was the first time we had gotten together, and it was great. We went out last night, and I've done the cheesesteak thing before. I learned a lesson. If you, go, if you go to Pat's, and I forgot what the other steakhouse is, they're across the street from each other. So if you go to one, and what I was doing was trying to do a taste test, and I was getting a sandwich from one, bringing it home to my wife, and getting a sandwich from the other, and bringing it home to my wife. They don't like that. They don't like that you walk over to, from one steakhouse to the other with the other steakhouse's steak. So
yeah, that's probably that doesn't go over well. And there's not many things that do go over well in Philadelphia, so I can imagine that that's probably a bad.
And they're not shy about telling you either.
Right. Well, welcome in, everybody. My name is Tony Bramley, and I'm the Director of Business Development here at the Mortgage Collaborative. Thank you so much for joining us today on TMC Connect. Today with us, we have Horst Tomaselli. He is the president of Project Review at CondoTech. He is hot off of the MBA annual train, so I'm glad that he's back in the office and with us today. He is going to be talking about release notes, the new Fannie Mae and Freddie Mac condo and co-op lending guidelines. I know this is top of mind for a lot of you out there, and we are very thankful that you're here. So, hello, Horst. How are you today?
I am really good, Tony, and I have to say thank you. I love the Mortgage Collaborative, and it's really provided us with an ability to talk to so many really important lenders across the country. So very happy to be here today.
Excellent. Thank you so much. Well, just a couple of things. You guys are on mute, but we do want this to be engaging. So please drop your questions in the Q&A or the chat, and we will be taking those at the end of the presentation. If we run out of time, I will be sending those questions over to Horst and his team so that they can respond to you privately. And then you will get a follow-up email tomorrow with this deck that he's going to be sharing with us, as well as a link to the YouTube video. So without further ado, Horst, I'm going to turn it over to you.
Thank you very much. So welcome, everybody, and thank you very much to this really important and timely webinar. What we really like to do here is really not take an enormous part of your day when we provide this type of information. So this webinar is really scheduled for 30 minutes. We're going to, again, try and take as many questions at the end as possible if time allows. And if it doesn't, we will absolutely respond back to you with our answers should you ask a question. So let me start running through this. I'm Horst Tomaselli. I'm the president of Project Review, as Tony outlined, at CondoTech. And what our products are within the industry are the Condo Pack, where we provide data, condominium questionnaires, and all the data necessary to review condominium and cooperative developments across the United States in a timely fashion. And then we also launched a couple of years ago a new product called the Condo Project Warrant, which has been incredibly successful, and I think it owes its success primarily to the fact that lenders really needed a resource in the industry for providing a warrantable review for condominium developments that they're lending in, or condominium loans, or the project review for those condominiums. So we provide that throughout the industry now to hundreds of lenders. Every single month, we have hundreds and hundreds of these condominium project warrants that we deliver out there in the industry. We also have our co-op pack products, which we offer for cooperative developments and cooperative lending. So the current market environment, well, I was really pleased to be part of the MBA's presentation to the New England Association of Mortgage Bankers recently, where Fannie Mae and Freddie Mac attended the presentation and provided their outline of these new lending guidelines for condominium cooperatives. I learned a lot during that presentation, and I learned a lot not only about Fannie Mae and Freddie Mac's guidelines and their decisions and what is moving them to make these decisions, but also parts of, other parts of the process, and specifically insurance. And we're going to get into that in a minute. There was a lovely woman who was brilliant, who attended that seminar, and her name is Krista Brady from USI Insurance. And she is an expert in HOA insurance. And I will tell you that I learned more during that 20-minute presentation that she provided than I have in a really long time about insurance. And frankly, I'm one of the insurance experts in the industry. So very surprised about the trends there. So Fannie Mae and Freddie Mac lending guideline updates went effective September 18th of 2023. Just last month. So they're less than 30 days old as far as their effectiveness is concerned. They've been around for a while, though, because they were released in July, and the industry has had, a bit of time to unpack what these guidelines really meant. And what we're seeing, and what we see within these new guidelines, is, of course, this focus on aging infrastructure now for condominium developments across the United States. Fannie Mae unavailable designation that came as part of Fannie Mae's temporary guideline release last year has really kind of been interesting to watch over the last year or so, because something like 1,800 or 1,900 condominium and cooperative properties have been added to the list of unavailable, or buildings or properties that are unavailable for lending within that period of time. And there's some, there are some really interesting reasons why some of these properties were added. And a lot of properties were added as a result of their inability to meet the insurance requirements that are outlined by the agencies, or specifically by Fannie Mae. And more often because the properties don't comply with their infrastructure condition requirements and this new focus on structural and mechanical condition. Don't get me wrong, there's a lot of reasons why properties end up on Fannie Mae's unavailable list. Excess commercial space, excess investor percentage, but we're starting to see a trend. And the trend is that a lot of these buildings and HOAs are ending up there because they have not either reserved appropriately for repairs and maintenance, have a structural issue in the property, or have some sort of mechanical component that is going to impact the health and safety of the owners of that specific condominium development, not repaired or not working. And that's been recently the bane of our lender clients' existence, right? Because it's very hard to get that information, even with the resources that a firm like Condotech provides. Sometimes it takes 2 or 3 goes at the management company to get the appropriate information on, structural and mechanical condition. There's an interesting thing that's happening in the marketplace where, the shift has been that if it's, the specific loan within a condominium or cooperative development is not compliant with Fannie or Freddie guidelines, that, there's a non-QM or non-warrantable solution for that specific loan, albeit at a higher interest rate or, lower LTV and larger down payment requirements. And there's an interesting trend happening where the secondary market is starting to essentially provide reciprocal, approvals and denials for, condominium developments that that are on Fannie Mae's unavailable list. So we saw this recently where we had an instance where we had a totally unwarrantable Fannie and Freddie Mac loan that we reviewed for a lender client, and they went to go take it non-QM and sell it into the secondary market and close the loan. And the building happened to go on Fannie Mae's unavailable list. And all of a sudden, the secondary market investor did not want to, close that loan, and did not want to provide financing in that building because of the Fannie Mae unavailable designation. So that's not true everywhere with every secondary market investor, but this is a trend that's starting to happen as everyone, it seems, is now focused on this aging infrastructure problem. And I'll outline this a little bit more in a minute as well. Before I go to the next next slide here, it's important to outline that I am a big fan of these guidelines. And, that's not a very popular opinion out there. I've learned that recently because I look at these guidelines as a compliance officer that's been in the industry for more than 25 years at this point. We've seen so many horror stories, or I've seen so many horror stories in the industry where homeowners that have, just closed on a loan, have a massive special assessment, forces them into foreclosure or can't even occupy the condominium unit that they just bought. We've seen these horror stories, and we've seen communities really go under as a result of, the deferred maintenance to their infrastructure, structural problems to these properties, mechanical issues, that just, haven't been really focused on over the years. And now, unfortunately, they have to be focused on, specifically because you can't get mortgage financing without, having a property or board that is in good physical, mechanical, and financial condition. So the agency initiatives that were released within this new guidance are also really kind of, industry changing. Based upon the information that was provided and released in the seminars that I've been part of over the last month or two, you could see a real interest from the agencies in trying to reduce the cost of underwriting condominium and cooperative loans. And them starting down this pathway of kind of aligning, these properties with the guidelines. And if you see that the agencies see that these properties are aligned with the lending guidelines, they're adding them into their essentially respective approved designation. So, it's not all bad news. It's not, only Fannie Mae releases an unavailable for lending list. Fannie Mae also releases, their CPM system, upgrades, which allow for you as a lender essentially to go in and see if a property is approved by the agency. Freddie Mac has a very similar process called the project certified status that you could find within their system as well. And these are initiatives essentially to have a large swath of condominium developments across the country that are approved within these agency systems. So your time to underwrite these types of projects that are approved, drops dramatically. And the cost that's typically associated with reviewing a project and ensuring that it's compliant drops as well. It's really reducing the cost of these property analyses. I mean, it's only a couple months old and we're starting to see that happen. The caveat to all of that is that there's still an insurance compliance review that's necessary. So even though one of these buildings, appears as approved on Fannie Mae's or Freddie Mac's list, you as a lender still have to do an in-depth insurance compliance review. And I have to tell you, the best practice is also to do a property condition analysis. Most lenders are still getting condominium questionnaires on these properties that are on the approved list, just to make sure that the mechanical and structural condition of the property, still remains in good condition. That's really important, right? It's not a one-step process yet where you could originate a condominium loan, go on Fannie or Freddie's list, see that it's approved, and close it. There is an intensive review that's still required, especially surrounding the property condition and insurance, and of course the reserves and the financial health of the property. But those agency initiatives, I have to tell you, were really, really enlightening and really interesting, because I anticipate and I hope that that's really going to change the face of condominium lending over the next 12 to 24 months as these new guidelines bleed into the industry. and boards and managers and and associations kind of align with these new lending guidelines, which happens to be our next kind of slide and outline here. So we're starting to see the industry shift towards compliance, right? Whereas a year ago, Fannie Mae's new 1076 questionnaire addendum was so new, and a lot of folks just didn't want to answer any of the questions on this new addendum. Not to say that that's gone away. There's a lot of states and attorneys in states that will not answer the structural mechanical condition reports or reporting requirements that are in the 1076 addendum. But by and large, we're starting to see this shift where these questions are starting to get answered. And they're not just starting to get answered, on the questionnaire. We're seeing that Fannie Mae's requirements of reviewing reserve studies and engineering reports, if they've been performed on the property within the last 36 months, are also being kind of provided regularly now, more regularly than before. We're not all the way there yet, but it's happening more often, where we'll go out to get docs on a condominium development and ask the questions on the 1076 in order to complete the questionnaire appropriately, and they'll forward over a copy of a reserve study or the most recent engineering report on the property. And frankly, that's what we want. We want a professional opinion on these properties on whether or not they suffer from any sort of deferred maintenance, or if there's some sort of aging infrastructure issue that's going to impact the health and safety of the unit owners. We're also really seeing lenders look at violations early on, trying to order title reports early on in order to see what the violations are on a property. And of course, if those violations are about the health and safety of the unit owners or impact the health and safety of the unit owners, obviously that has to be resolved before you can close a loan. Essentially, right now, as most of you on this call know, any repair that could cause a health and safety issue, meaning that any repair to a component that could cause a health and safety issue, has to be completed before you can close a loan in these properties. And that boils down to, in some instances, not like some sort of major structural problem, which requires completion as well, but sometimes it's it could be as simple as a problem with their HVAC system, a system-wide issue that doesn't provide air conditioning in a building in Las Vegas is a major issue, or a system-wide issue that doesn't provide heat in a northern state is a major issue. So that's changing in the industry, but we are seeing that these associations are starting to shift towards compliance. And I think that's as a result of the education that's being provided in the industry, directly to the property management groups and directly to the boards. Again, we're not there yet, but we're getting closer. We're not that close, but we're getting closer. There's also this focus, of course, on special assessments and critical repair completion, as I outlined. But special assessments, the focus of the special assessments is really to define whether or not a building or an association has created a special assessment in order to complete some sort of major critical repair. Not all special assessments are bad, and some buildings operate via special assessments, and that was outlined very clearly by Fannie Mae and Freddie Mac in the last couple of seminars that I've attended with them. There are instances where a special assessment can be levied against unit owners for the repair, let's say, of a roof. And let's say the cost is $300,000 to repair a roof. If that association has enough capital in its account without, putting the special assessment on the unit owners, or prior to putting a special assessment in there, essentially paying themselves back for that roof repair, then that's an acceptable special assessment, as long as it's not going to impact the health and safety of the association and is not considered a critical repair, which you really have to define very specifically. So the answers here are, you really have to ask the right questions when getting the questionnaires from the associations. You have to order this documentation as early as possible, ordering title reports as early as possible. You have to request all the necessary data, right? Because we know we're going to need information on the structural and mechanical compliance. So we know we have to ask for a reserve study or an engineering report on day one as a result of these new guidelines. So we like to do that, right? So, if you're engaging condo tech to do that work, we're doing that on day one. If you're doing this on your own and reviewing these projects on your own without one of our warrants to eligibility, then you really want to follow these rules and follow these directions and getting this documentation as early as possible, as soon as your client, a purchaser or borrower, it decides to proceed with you. So some of the trends that we're seeing, and some of the stuff I really want to spend some time on here, is that, again, board focus is starting to shift towards lending compliance. Boards are figuring it out, right? If they're on the Fannie Mae unavailable list and they can't get mortgage financing, and purchasers can't get mortgage financing, it's a big deal. Values are starting to go down as a result of this, right? If you have a building that's on Fannie Mae's unavailable list as a result of some sort of massive work that has to be performed, it's just another step for an attorney, or another place for an attorney who's representing a purchaser, if they are, to uncover some sort of problem with that purchaser buying a unit. And that always translates into value, right? We're seeing, and we have seen over the last couple of months, very enterprising real estate agents and attorneys who are, essentially have their clients purchasing a unit let's say in a building. We saw this specifically. Saw a client purchasing a unit within a building that was on Fannie Mae's unavailable list, in a building that was going to levy a special assessment. In the case that we saw, the purchaser got a $25,000 discount for the unit as a result of that property being on Fannie Mae's unavailable list, and as a result of a special assessment in the amount of like $6,000 or $7,000 that was going to be levied on the unit owner. This purchaser got a $25,000 deduction. So we're seeing that starting to become prevalent. We're starting to see reserve analyses become prevalent. We're starting to see more and more condominium and cooperative developments have a reserve study. And it kind of makes sense, right? It's one of the easiest ways for an association to limit their liability when answering questions on a condo questionnaire or a cooperative questionnaire. We're also seeing a massive increase in capital loan acquisition. So, it wasn't very often that I used to see condominium developments, get a loan. I'd see them out there. I'd see condominium associations get these Sierra loans to do repair work to a property. But it wasn't that often that I would see it. All of a sudden, there's a major shift. And that's as a result of more capital being necessary in order to keep a lot of these developments afloat, essentially, and keep the critical repairs completed, and to complete critical repairs, or more importantly, to make sure that these buildings are compliant with lending guidelines. So we're seeing boards and associations, HOAs, go down the road of getting a capital loan to do all of this work. And one of the biggest catalysts right now is this push towards carbon emissions reductions and the state's laws regarding carbon emissions reductions. Like in New York, in the state that I live in New York City, if there's a new law, Local Law 97, and you have to start reducing your carbon emissions if you're a building that's more than 25,000 square feet. Most buildings in New York City are. And the cost to reduce your carbon emissions may require the swap out of all of your boiler components, or the windows in the property, and the costs for that are extensive. So these capital loans are on the rise, and they're accepted by Fannie and Freddie in lieu of a special assessment. So our opinion is that you're going to see these things go through the roof. You're going to see a lot of action in that area. Stakeholders are starting to become aware of these requirements. Condo boards, property managers are finally starting to figure it out because they're seeing some of the pain of not being able to get loans approved. Project review, again, is now beginning upon loan origination, right? We're seeing that enterprising loan officers are looking at a property saying, are there any issues on this? Let me see your questionnaire. Let me see the last questionnaire completed on this property. Get your hands on that. Let me see what the issues are. And most importantly, and the thing I really want to focus on, I want to let you know about today, and I alluded to it before, there was this, really smart woman who got on this presentation last week for the New England MBA, Krista Brady from USI. And she was outlining that the insurance industry, by the way, if you haven't noticed this, costs for HOA insurance have gone up between 100 and 300% in the last 24 months. So we've even seen boards that are paying $80,000 a year in insurance now paying close to $400,000 a year in insurance costs. But the insurance industry has aligned with Fannie Mae and Freddie Mac's policy requirements and the aging infrastructure issues across the United States. So if your building has a reserve study, sometimes you can't even get insurance for your property unless you provide a reserve study to the carrier to show that you have enough capital in reserves, to show that you have a maintenance plan, to show that you're doing the necessary repairs, and to show that you've had an engineer look at the property. And that's not a mistake. Essentially, the insurance industry has figured out that most of the claims that get paid as a result of issues with the infrastructure of a property. So major trend change in the industry right now. So I would like to announce, and I think most of you who are on this have heard this. So last week we announced that we have now partnered with MGIC at Condo Tech. So if you are doing a review with us, and we do approve the specific condominium or cooperative development that you have, or let's limit it to condo for this conversation. Let's say we approve that condo development for Fannie Mae or Freddie Mac mortgage availability, and we warrant it. MGIC provides automatic mortgage insurance for that property. And what we're trying to do, and there are a lot more partnerships going to be announced over the next year, what we're trying to do here is to make it much easier for our lenders to close transactions and to close them more quickly. And by doing this and by aligning with a firm like MGIC, we can do that in a very efficient manner where you could essentially underwrite a condominium loan, we could warrant that property, and you could automatically have mortgage insurance on that property based upon our warrant. So just one of the things we're bringing to our TMC partners here in the industry. As always, I always try and provide some resources. The best place to find information is Fannie Mae's FAQ link. Freddie has an FAQ link as well, which you could find through the link I provided here. Fannie Mae's lender letter is here. Freddie Mac's lender letter is here. Their bulletin. But I'm telling you, if you're underwriting condominium or cooperative loans, that's the place to look. Start there because they answer a bunch of questions that we get every day. And we love that Fannie and Freddie put them in black and white for everybody to see. Just because, there's this massive surge in repurchases around the industry of lenders closing loans in projects and properties that aren't compliant. And, we warrant your project, so that doesn't happen if you send it through Condo Tech, but we will tell you that if you're warranting your own projects and essentially you're reviewing your own projects, condo and co-op, this is the place to go to try and avoid any repurchase. Just look at these guidelines very closely, or call us, or order a condo project warrant. One thing's just as easy as the other. Our contact information is here. We try and really make condominium lending simple and try to provide you with the resources that are necessary. So thank you for the time. And Tony, are there any questions today?
I didn't see any, so if you guys have any, please feel free to drop them now. Just as a reminder, I will be sending out an email tomorrow with the video attached, as well as the deck, so you'll get all of these links and everything that you have so conveniently provided for us. So thank you so much for that as well. Thank you for stopping by today. Come back Tuesday, Wednesday, Thursday. Join us on Fridays for the rundown. We appreciate that you are here. And Urs, thank you so much for bringing all this amazing information to us. Appreciate your expertise and your willingness to share it with the Mortgage Collaborative.
You're very welcome. I'm a big fan again, and I'm a big, I'm very happy to be a partner here. Thank you.
Great. Thanks so much. Well, have a great rest of your week, everybody. And thank you again for being here. Appreciate it. Bye-bye.
Bye.